When you're working, you pay federal tax, state tax, and you also pay into Social Security and Medicare, also known as FICA. How do your taxes change, and how are your different investments taxed during your retirement? That's what we're going to discuss in today's video. Hi, if we haven't met yet, I'm Trevor Johnson, founder of Dreamweaver Financial Planning. I help hardworking savers who are in or near retirement turn their savings into financial freedom. At the start of the video, I mentioned that when you're working, you pay federal tax, state tax, and you also pay into Social Security and Medicare, which is also known as FICA. Once you retire, now this assumes that you're not working part-time, you no longer are working, you no longer pay into FICA. So you were paying 6.2% of each paycheck into Social Security, and you're also paying 1.45% of each paycheck into Medicare. So once you retire, you are no longer paying a total of 7.65% into Social Security and Medicare. So the good news is you no longer need to pay into Social Security and Medicare. However, you do still need to pay federal and state tax. Unless you're fortunate enough to live in a state with zero state income taxes, such as Florida or Texas. There's two very important charts that I'm going to refer to throughout this video. The first one shows the ordinary income tax rates at the federal level. So when people talk about tax brackets, this is typically what they're referring to. The second one that I'm going to show is a chart that shows how capital gains are taxed. Now I'm going to go over the different types of income that are received in retirement, and I'll talk about which tax chart they apply to. So whether they apply to ordinary income or the capital gains chart that we showed at the beginning. The most common form of income in retirement is Social Security. Between 0% and 85% of your Social Security income will be taxed. What this means is up to 85% of your Social Security income will be added to your total taxable income. It doesn't mean that you're going to lose 85% of your Social Security. Let's go over a very simple example to make sense of this. Let's say that your Social Security benefit is $10,000 per year, and due to your provisional income, 85% of your Social Security is going to be taxable. If you're not sure what provisional income is, check out this video next. So in our example, we would take 85% of $10,000, which would come out to be $8,500. Now, if you're in the 10% federal tax bracket, what that means is you would owe $850 in taxes on your $10,000 of Social Security income. Now, this is federal tax. At the state level, most states either don't tax Social Security or they have a lower rate for Social Security income. So you'll need to check into your specific state. Another very common form of income in retirement is pension income. Most pension income is taxable at the federal level, and at the state level, once again, it varies. So some states don't tax pension income and some do. It just depends on your specific state. The next form of income I'd like to talk about is interest income. Interest income is typically taxable at the federal and the state level, assuming that you're holding it in a taxable account. So think high yield savings accounts, corporate bonds, and money market funds. There's really no tax advantages to any of these. They're heavily taxed. Now, if you own a treasury bill in a taxable account, you actually owe federal tax on it, but no state tax. So if you live in a state such as Florida or Texas where there are no state taxes anyway, it doesn't really make that much of a difference to you. However, if you live in a state with high taxes, state taxes, say such as Illinois, then it would benefit you more because you would owe no state tax on the interest that you earn. You would only owe federal tax. Another type of interest-bearing investment that's worth noting here are municipal bonds. Now, municipal bonds, you do not owe any federal tax on the interest that a municipal bond generates. However, you do owe state tax on municipal bond interest, unless the bond was issued from the state that you're a current resident in. In that case, you would owe no federal tax or state tax on the municipal bond income. So one very important lesson here is if you're looking at, say, a money market fund or a treasury bond or a municipal bond, what you have to do is you have to do an apples to apples comparison on the interest rate. So you're choosing the option that makes you the most money. Something worth noting here is the examples that I'm giving are as if you were to hold these bonds or interest-bearing investments in a taxable account. If you held these bonds in, say, a traditional IRA, then all of the interest that they would make each year would just be tax deferred, and then you would pay taxes on it when you pulled it out. Now, if they were in a Roth IRA, all of the interest that they make over time would actually be tax-free when you pull it out in retirement. We also mentioned municipal bonds earlier. Every once in a while, you'll hear stories about investors who are holding municipal bonds within retirement accounts. That doesn't make a whole lot of sense because the whole advantage to a municipal bond is the fact that you don't owe federal taxes on the interest that it makes. So the place that it makes the most sense to hold a municipal bond is in a taxable account. Also, when you buy a municipal bond, the issuer knows that you're not going to owe federal tax on it, so they offer you a slightly lower rate than its taxable equivalent. So if you were to buy a municipal bond and have it in a retirement account, it wouldn't make a whole lot of sense because you could buy a different interest-bearing investment with a higher rate. So if you do own municipal bonds, it probably makes the most sense to hold them in a taxable account. Another form of income that's common in retirement is dividend income. Now, if you have what are called qualified dividends, they would use that tax preferential chart that we showed at the beginning, the capital gains chart, instead of the ordinary income chart. So it's important to know if you do buy an investment that's going to generate dividends, whether they're qualified or non-qualified. But just remember, qualified dividends do have special tax treatment. If you hold any investments in your retirement outside of a retirement account, so in a taxable account, it's important to know the difference between a short-term capital gain and a long-term capital gain. If you have a short-term capital gain, it means that you've held the investment for less than a year. A long-term capital gain means you've held it for over a year. Now, at the beginning of this video, we showed two charts. If you have a short-term capital gain, meaning let's say you bought stock in Apple and you sold it within 6 months, and let's say it went up $100 in value, that $100 short-term capital gain would go into that first chart that we showed. So the federal ordinary income tax brackets, okay? It would get taxed at most likely a higher rate than if you had a long-term capital gain. So if you held that stock for over a year, you sold it, you had a $100 gain, then you'd get to use that capital gain chart that we showed at the beginning, and you'd pay a much lower rate in taxes. There's a common thing that trips up a lot of investors in retirement, which is what they'll do is they'll buy a mutual fund that's made up of all stocks, and it'll be held in a taxable account, and they won't sell any shares. And what'll happen is at the end of the year, they'll get a tax form and it'll say that there were some capital gains that had been triggered. And the reason this is because a lot of mutual funds have a manager who's actively buying and selling the stocks in the fund. And when this happens, it triggers capital gains. And then the investor who owns the shares, who owns the mutual funds, has to pay taxes on the gains that had been triggered. So it's important when you buy a mutual fund to look at what the turnover rate is, or the percentage of assets that the fund manager typically turns over per year. So the higher the turnover rate, the more in capital gains tax you'll probably owe. Now, a lot of people talk about the advantages of index funds, and one of the advantages to index funds is they have a very low turnover rate. So if you hold an index fund in a taxable account, then a minimal amount of capital gains will be triggered if you just buy and hold it. One thing worth noting is we've talked about a lot of different types of investments and how they're taxed in your retirement. If any of these investments are held in a Roth IRA, when you withdraw some of that money in your retirement, you don't owe taxes on any of it, assuming it's a qualified distribution. Now, if you have a traditional IRA or a traditional 401k in your retirement, that money, you don't pay taxes on it year to year because it's all tax deferred. But when you start making distributions in your retirement, then the entire distribution is taxable income. A good Roth conversion strategy takes advantage of the fact that you can control how much money you pull out of your traditional IRA each year. That way you can ultimately save the most on taxes. Just remember that when you take a distribution from a traditional IRA or 401k, that it is fully subject to federal income taxes, and some states tax traditional IRA contributions at the state level and some don't. So you need to look up your specific state. Another somewhat common form of income in retirement is rental income. And there's a very common misconception with rental income and how it's taxed. What you do is you take the amount that you receive in rental income and then you subtract out all of your expenses associated with it. So if the rental property has property taxes, if you had to make some repairs, if you're paying mortgage interest, there's usually depreciation. So you pay taxes on the net rental income, so the amount remaining after all of the associated expenses are subtracted out. So rental income is taxable at the federal level. There is one more tax worth noting here for retirees, and it's called an IRMA surcharge. And what it means is that you pay an additional Medicare premium if your income exceeds a certain threshold in retirement. Hopefully you found these retirement tax tips helpful. I try to put out 1 to 2 videos per week to help retirees with their finances. Just remember that the tax code is not in stone and it's always changing, and it's important to keep up on all the new laws and regulations. Please hit like and subscribe so you'll be notified when my next video comes out.